The stock market is a machine designed to transfer wealth. But it is not from the unintelligent to the intelligent. It is from the unprotected to the protected. The game is not won by the man with the most brilliant forecasts, but by the man who loses the least when he is wrong. Every amateur who walks onto the trading floor believes he is there to make a fortune. This is his first and often his last mistake. He is not there to make money. He is there, first and foremost, to survive. He asks, "How much can I gain?" The professional asks, "What is the maximum I am willing to lose?" This single change in perspective is the dividing line between the 90% who fail and the few who endure. The market does not reward courage without caution. It does not pay for hope. It pays for correct speculation, and the foundation of all correct speculation is the preservation of your capital. You are not a speculator until you have lost money, and you are not a professional until you have lost it all and come back. The lessons I paid for with my own fortune time and again are documented in my biography, Reminiscences of a Stock Operator. Study it so that you do not have to pay the same price. You can find a link in the description of this video. Do not treat it as a story. Treat it as a warning. The great mistake made by the public is the belief that trading is a constant activity. They see the ticker tape as an invitation to a perpetual dance, believing that to be out of the market is to miss an opportunity. This is a broker's lie. The broker profits from your activity, your churning, your indecision. You profit from your stillness, your patience, your precision. I made my greatest fortunes not by constant trading, but by correctly assessing a major trend and then having the fortitude to sit tight. The money is not in the buying or the selling, it is in the waiting. Yet the average man cannot stand to be in cash. It feels like idleness. It feels like failure. To him, a position, any position, is better than no position at all. He would rather lose money on a bad trade than make no money while waiting for a good one. This compulsion to act is a psychological disease that enriches the brokerage houses and empties the accounts of their clients. I learned that my greatest enemy was the desire to force a trade where none existed. After a successful campaign, I would take a vacation, clear my head, and return to the market. But the itch would return with me. I felt I had to be in the game, and I would place a bet on a stock without a clear signal, without the line of least resistance being defined. These were my donations to the market, tuition paid for the lesson of patience. The market has only one side, and it is not the bull side or the bear side, but the right side. My job as a speculator is to identify the direction of the great underlying trend and join it. This requires observation, not constant participation. There are times when the market is a tangled mess, a choppy sea with no clear current. To trade in such an environment is to volunteer for financial punishment. It is in these moments that the professional proves his discipline. He sits in cash, his capital safe, his mind clear, waiting. He knows that the market will eventually tip its hand. A great move will telegraph its intentions. Accumulation precedes a markup. Distribution precedes a markdown. These things take time, and they leave footprints on the tape for those who are patient enough to watch. The amateur is a sprinter, dashing in and out, exhausted and broke. The professional is a sniper, waiting for weeks, if necessary, for the one perfect shot. Survival dictates that you do not fire your rifle in a fog. You wait for the weather to clear. You wait for the line of least resistance to declare itself. The rule is this. Cash is a position. Often it is your best and safest position. Do not trade out of boredom or a need for action. Trade only when the market presents a clear, high-probability opportunity. Your capital is your ammunition. Do not waste it on random shots. Conserve it for the easy targets. Of all the speculator's mortal enemies, hope is the most treacherous. It is the siren song that lures accounts onto the rocks of ruin. Hope is what a man clings to when he has no facts, no system, no reason. It is the justification for holding a losing trade. It whispers that the stock, which has already gone against him, will surely turn around. It promises that his initial judgment, though proven wrong by the tape, will eventually be vindicated. The market, however, is a realm of facts, not feelings. The tape does not lie and it does not hope. It simply is. When a stock moves against you, it is a statement of fact that your judgment was incorrect at that moment in time. To hold on is to argue with an undisputed reality. This is not speculation. It is a prayer. And the stock market is the wrong church for praying. The deadliest manifestation of hope is the practice of averaging down a losing position. A man buys a stock at 50. It drops to 45. Instead of accepting the small loss, his pride is wounded. He must prove he was right. So he buys more at 45, lowering his average cost. He tells himself it is a better bargain now. The stock then falls to 40. He is now losing twice as much on a position that has twice demonstrated his error. This is the logic of the asylum. I learned this lesson with a cargo of cotton. I was bullish. I had my reasons. I bought a line of futures and the market immediately began to move against me. I was Jesse Livermore. I had been right before on a grand scale. I could not be wrong, so I held. The market did not care about my reputation. It continued to decline. My broker, a wise man, advised me to take the loss. I refused. My opinion was my God, and I would not be an apostate. I bought more. I averaged down, convinced the turn was just a point away. My paper losses mounted until they were catastrophic. I was no longer speculating on the price of cotton. I was fighting to save my own ego. I was finally forced to liquidate, taking a loss so severe it nearly ended my career. I had violated my most fundamental rule. I had substituted hope for observation. I had argued with the tape. The rule is this: never, under any circumstances, average a loss. You are in the business of buying what is rising and selling what is falling. When you average down, you are buying more of something that is actively proving itself to be a poor speculation. Take your initial loss, no matter how small. It is the cheapest insurance you will ever buy. A small loss is a tactical retreat that allows you to fight another day. A large loss, born of hope, is a strategic disaster. The amateur yearns for speed. He believes the road to riches is a short one, and he searches for a vehicle to get him there overnight. That vehicle is almost always leverage. He sees margin as free money, a tool to magnify his genius and accelerate his destiny. He opens a $10,000 account and immediately controls $50,000 worth of stock. He calculates that a 10% move in his favor will not make him $1,000, but $5,000. He is intoxicated by the potential gain. He gives no thought to the potential loss. He does not understand that leverage is a double-edged sword, and its other edge is razor sharp. The slightest adverse move, a normal market fluctuation that an unleveraged account would barely notice, becomes a mortal wound. That same 10% move against him does not cost him $1,000. It costs him $5,000, half his capital, in a single stroke. He is crippled before the game has even begun. This is not speculation. This is a lottery ticket purchased with borrowed money. It is the fastest way to leave the business. In my youth in the bucket shops, I lived by leverage. The margins were thin and the game was fast. It taught me how quickly a man can be wiped out. This lesson, however, became my greatest strength when I learned to apply it correctly. I learned that leverage must be earned. It is not a tool for initiating a position. It is a tool for pressing a winning one. My method became clear. I would first probe the market with a small position, a fraction of my intended size. I was testing my thesis. If the market moved against me, I would exit with a tiny, inconsequential loss. The probe failed. But if the market moved in my favor, if my initial judgment was confirmed by the tape, then and only then would I add to my position. I would pyramid. And as my paper profits grew, I would use that unrealized gain, the market's own money, to finance further purchases. My risk was always defined by my original stop-loss. The leverage was applied not to my own capital, but to my profits. The professional uses margin to compound a proven success. The amateur uses it to finance a hopeful guess. The rule is this: treat margin with the same respect you would a loaded firearm. Do not use it because it is available. Use it only when you have a significant advantage, when a trade is already working and the line of least resistance is clear. Use it to build upon strength, never to support weakness. Your survival depends on it. A speculator cannot be successful by focusing on a single tree while ignoring the forest. Too many traders hunt for a bargain, a special situation, a stock they believe is poised to move, without ever looking up to see which way the wind is blowing. They may be brilliant analysts of an individual company, but they are doomed to fail if the general market tide is moving against them. A bull market is a rising tide that lifts all ships, even the leaky ones. A bear market is a receding tide that grounds them all on the sand, regardless of how seaworthy they appear. To bet on a single stock to rise while the entire market is in a downtrend is to bet on a salmon to swim up a waterfall. It may be a strong fish, but the forces aligned against it are overwhelming. My greatest evolution as a trader was the shift from playing the daily fluctuations, what I called the stock-a-day game, to concentrating on the great swings. I realized that to win, I first had to be right about the overall market. Is the underlying trend bullish or bearish? This was the first and most important question. Only after answering it would I proceed to the next step, identifying the strongest industry groups within that trend. Money does not scatter itself randomly across the board. It flows into specific sectors. In a bull market, certain groups will lead the charge. In a bear market, others will lead the decline. My job was to find these leading groups. The final step was to select the strongest individual stock within that leading group. I was not looking for the laggard, the cheap stock that had not yet moved. That is the amateur's game. I was looking for the leader, the stock that was already making new highs, the one showing the most power. Strength begets more strength. By aligning my trade with the general market trend, the leading sector, and the leading stock, I placed the great forces of the market behind my back. I was no longer fighting the current, I was riding the crest of the wave. The majority of traders fail because they ignore these macro conditions. They are so focused on their one ticker that they are blindsided by the avalanche. The rule is this: always trade in the direction of the general market. Diagnose the health and trend of the overall averages before you even consider an individual stock. Survival requires that you swim with the tide. To fight it is a guarantee of exhaustion and financial ruin. Ultimately, the entire game of speculation can be distilled into a single imperative: survival. It is not glorious. It is not exciting. It is the grim, methodical, day-to-day business of protecting your capital so that you can stay at the table. The market will, from time to time, present opportunities of such magnitude that they can change a man's life. The great bull markets, the historic panics, these are the moments where fortunes are made. My shorts in 1907 and 1929 were the culmination of years of observation, waiting for all the pieces to fall into place. Those trades created wealth that lasted for years. But they would have been impossible if I'd been knocked out of the game a month earlier on a foolish, ill-conceived trade in sugar or corn. The opportunity of a lifetime is worthless if you do not have the capital to act on it. This is the truth that 90% of traders never learn. They treat every day as a battle for glory. They take enormous risks on low-probability setups, hoping for a quick score. They swing for the fences with every pitch. And so, they strike out. They are not at the plate when the easy pitch comes right down the middle. I went bankrupt more than once. Each time was a masterclass in failure. I learned what not to do. I learned that my ability to make money was useless if I did not have a system to keep it. Each time I clawed my way back, it was with a smaller stake and a larger dose of caution. I became a defensive player first and an offensive player second. My primary thought was no longer, how can I profit from this? But how can this setup cause me to lose? I studied the exits before I planned the entry. I defined my risk to the penny before I committed a single dollar. I realized that a string of small, controlled losses is survivable. A single, uncontrolled loss is not. The market will always be there tomorrow. The question is, will you? Survival is a victory in itself. If you can navigate the difficult periods, the choppy, trendless markets where most traders are ground to dust, and emerge with your capital intact, you have succeeded. Because the easy periods will inevitably return. The clear trends will reappear. And when they do, if you are still in the game, the profits will be automatic. The rule is the summation of all other rules. Your number one job is not to make a profit, but to protect your capital. Prioritize defense over offense. Master the art of taking small losses. Live to trade another day, because the day will come when the market will lay gold at your feet. You simply have to be there to pick it up.